Garland Nixon. He's funny. Yeah. So, Brother Will, yeah, I went through my inventory. All I got is that one trade on. I gotta populate the trades again because and then I gotta change my pricing because market just open. And let's see what we got here. Gold, the GDX. I'm still gonna try to again. I'm just trying to get extra credit, see if this thing will work. And GDX. Yeah, I could do GDX. Yeah, with the possibility of in my mid prices. I mean, my price is way off the mid price, but I don't mind that. I do not mind that a bit. Okay, let's go to Freeport McMoran FCX. Okay, that fell a little bit. What's going on with FCX? Okay, maybe I can get more credit. Um, it still has more risk to the upside because of the skew. Copper, well, actually, stocks in general have been falling down. And again, we'll go back, because I'm getting a little ahead of my skis. First and foremost, SPX. It is down just barely, so it's pretty much flat. Anything under 20 to me is flat nowadays. Um, we could look at Nasdaq, which same thing. When I see the fact that Nasdaq easily a move of 266 points in the last 4 days, or no, excuse me, yeah, 260, 289 in the last 21 days. I'm not going to freak in 96 points either way. VIX, that's what I want to see if it elevated at all. 46 cents. It's only at 18. To me, VIX is not really going anywhere. When VIX goes up, that's usually when you want to start selling premium. And so it's kind of hard to find these trades that sell premium because VIX is not going up. And bonds. When I say going up, you're looking at, 18 VIX, and the trend is going down. I'm kind of like, oops. Let's go back. Let's try to find bonds. Okay, bonds are continuing to go down and down and down and down and down as this volatility goes through the roof, which means, but see, TLT, volatility in bonds is great in terms of some plays in bonds. We'll do the futures later. I'm just telling you about income-driven trades. But TLT, on the other hand, our proxy, 77 IV rank. But what's the IV index in TLT? Look at the IV index. It's 77 there. 5 days has been going up. And the IV index is 21. So, it's not bad. It's not like great in terms of implied volatility on the TLC. So, but implied volatility IV rank has been going up. But man, look at this. Look at the individual expirations implied. Well, no, they're going up. It's more elevated than it's been in a while. November 15th, somebody's expecting something on the 15th. Why? elections. Because look at implied volatility go right back down after the 15th. How many days is that? That's only 23 days? Ugh. Ugh. See what we got in the first standard deviation. All right, let's look at the strangle. First standard deviation, 91. So that's 1% of the actual, there's 1% of the buying power. I would never do a strangle with only 1% of the buying power. That's, there's no way. But I'm just saying that with 1% of buying power, clearly that's not enough premium, even if it's that bump in election day madness, for me to even consider thinking about a possibility that might be a premium selling event. Maybe selling puts, just to, but see, TLT has just been decimated and there's risk to the upside. If we look at the chart, TLT has just been decimated. And if we go back to our strangle, and we can look at our skew. Let's go to that November 15th where the implied was extremely ridiculously high. Let's go to the deltas, the first standard deviation deltas. 17's close enough right there. First standard deviation deltas, 16 right there. And if we go in, we could see that, look at that. Let's expand it just a little bit. Oops, a little too much. Bring it down a little bit. And a little bit more. Oops. Okay, we want to see, oh, wait a minute, that's too much. You could see that there is a little bit more risk because if we go to our short strikes, we'd be down 139 if it moved up there today, and we'd be down 111 to the put side. So there is a little bit more, volatility to the upside. But in terms of a trade, I mean, you're only getting 1% on the strangle. That would be a non-issue. Even if I wanted to do a condor with tighter strikes, I mean, if I went and did a $5 condor, let's go $10. If we were to do $10 on this thing on TLT, $10 either way, we'd be getting less than 10% on less than 10% of our buying power for this. It's just not feasible. Even if we tightened up the strikes in order, say $2 either way, $2 either way, we'd only be getting less than, what is that? 20%? No, wait a minute. Yeah, 20% of our buying power. It's not a trade that I would do. Again, I like to look at the very first thing I look at. And if I were to do this, it'd be a different type of trade. But the first thing I always do is I look at the out of the money or the first standard deviation strangle to tell me how expensive this thing is. That tells me that if there's a lot of premium to sell or a little premium to sell. That's the first thing that I want to know is how insane could this thing be in terms of selling. KW, good to see you. Good to see you there, Brother Will. So that's the first thing I see. I put on the trades that I was that I didn't get into yesterday. I'm trying to get right back into it today to see if we can get in there. So I have the Freeport McMoran. I got Freeport McMoran. That's the other one I'm trying to get in. FCX. But it went down a little bit, and it's down 90 cents. 90 cents on a $47 stock. So let's see, what is FCX? It fell, how many percent would that be percentage-wise? Yeah, almost 2%. The volatility is definitely still It's on the floor right now. It's only down. It's like 79. And it only had a few spikes this year. I'm trying to just get the strangle. If you see that range right there, I'm just trying to play the strangle. Play the strangle a little bit and see what happens after that. This thing again can move about $3, either way. And so what I did is I still have that strangle that I'm looking at on Freeport-McMoRan. Except here's the kicker. You got earnings in a couple days. So that's the thing. I didn't see it when I was first looking for it. I didn't see the earnings thing. There's no way I would take this trade. We got earnings in 2 days. Okay, that's why. Okay, yeah. Oh no, I'm gonna wait till after earnings. I don't like to do trades in earnings. We could do income, but that's more speculative. Earnings trades is like non-farm payrolls. So good. I'm not doing Freeport-McMoRan. Okay. KRE, that was the other one. We've got FCX, KRE, SLV. I'm trying to redeploy silver and get back into silver because of, and I'm looking at, again, the December expiration. I already checked the temperature of all the markets. I checked my inventory. Now we're looking for opportunities. Remember, I do everything systematic. Start by checking inventory, and then go in and I looked at the previous inventory. First off, I look at the markets. Where's the sentiment of markets? A lot of fear. Where's the cost of money? And where's the cost of commitment? Then after I do that, I check my inventory. The trades that I didn't get in, this is where we're at right now. It's the trades that we're in the inventory stage. I check the trades that I already have. I only have one on, and I'm trying to get more trades on. And, it's just a matter of pricing. I'm a cheapskate, so I'm trying to buy things cheap or sell them expensive. So if we're looking at this, which is SLV, remember, this is part of the inventory. Again, there's massive amounts of risk to the upside, even though SLV has fallen 82 cents, and that's 82 cents on a $30 stock. That's like 2.5%. On a $31 stock. And if you see that, remember, this thing can move easily $1.40. Again, actually $1.54 is what I'm pricing in, because I always double the ATR in terms of what this thing can move, just so that way I can be more protective. Even though it says in the last 21 days it's moved an average of 77 cents, today is already 80 cents. And the market's just open. So this thing can move $1.54 is what I always double. So I'm just saying, but look at the upside. Remember, check this out. If it hit our short strike at 40, we'd be down $186. If it hit our short strike down here, we'd be down $86. So there's more risk to the upside, and yes, SLV is falling. So we could do this. Just because I wanted to redeploy, I'm going to pull that down to the 27. No, I'm going to keep that at 40. Nope. Let's see, 28. We'll get back to 28. 70 cents. 7 times 3 is 21. So I'm getting less than a third of the buying power right there. So it's not really like the best of trades. And that's the problem I had yesterday is I was trying, if I could have gotten around 80, I would probably take the risk in terms of doing that, getting in that particular trade. But we'll see what happens. And when markets settle down, we have a 92 cent probability, but I don't care about making $35 per contract in that. We got 90% chance we'll make 50%. We get paid $1.77 a day. And we got a 75% chance that this thing is going to expire. That is going to expire, giving you a penny or more. If we were to change this, I would change my deltas, even though the 40, remember all that money that was sitting at the 40, the thing that I noticed is our deltas, okay? I would have to bring this down in order to make this feasible. I brought this down to 37.27. The thing is we barely hit our buying power, our credit. Even though we're more delta neutral, we barely hit the credit and gamma due to the fact that this thing, again, the gamma is the frown. How bad of a frown? Look at how far, again, you're down $168 if this thing just shot up tomorrow. and just went buck wild ballistic, you'd be down that. And remember, every trade I get in, I always I have to adjust the trade. I'll always look at it. So let's see if we were to look at this as a new strategy in terms of strangles. Again, I'm always looking at the strangle. Okay, 20 is about as close as it gets to the 16 standard deviation, and 17 right here. 91 cents. Okay, now we're getting somewhere, but here's the kicker. 37. Okay, I wonder why I didn't see that earlier. 37.28. This is December 20. If I were to take this trade, I'm going to make the market come to me. If it doesn't come to me, then it's not worth it. But let's take a look. We've got volatility. There's no problem with volatility. The only thing that is an issue is volatility is up, and it doesn't look like it's going down anytime soon. But I don't mind that. What I'm looking at is this is possibly because of geopolitical tensions, election, the whole 9 yards. And by December 20th, things should be kind of settled down, which I wouldn't doubt that you would probably see a normalization of silver going back down in volatility. This one, you only have an 87% or 89% chance of making 50%. You get paid $2 a day, 71% chance, and the deltas are a little better. The only problem I have with this is every dollar it moves, you're going to lose $11 in gamma. Why? You're going to lose $14. Why are you going to lose that? Because of the fact that that smile. Remember, I told you that smile is going to literally, it's going to impact you. The thing is our strangle is a little closer. It is, or a lot closer, I should say. The strangle is a lot closer. So, you're definitely going to have to adjust. But you're getting paid the credit. I'm trying to get 93 cents in this. And we'll see, when things settle down, you might even be able to get $1. If we could get $1, at least we're getting paid for the risk. If it goes and hits us this bad, and it goes up there tomorrow, we'd be down 140. As if it went down to the downside and just collapsed, we'd be down 80. So the thing is we're still 3 deltas. So I could still adjust this to make it more delta neutral. But I do want that upside. I want more room to the upside. So if this thing goes and I noticed this a lot of times when I put the trades on, that this thing will more than likely fall before it skyrockets. If we look at silver's chart, of course, you've got room to the downside because look at what, you had that one day where silver popped up through the moon. So I could expect silver to fall a little bit, getting back into the, maybe the 29-ish area. I'm not saying it has to, but why not? It could. I mean, it's cool. Folks will call that resistance. I call it's cool. So it's possible that it could get down there. Remember, it could, on the average, I double the average, moving 144 cents a day. So it could easily get down there, in a couple days to the 29 area. The thing is, again, we're not in the middle of the hill. If I were to do this, I would bring this guy down and this guy down, but it's really making it more risky in terms of our deltas. Even though we have the hill, let me just do this. Yeah, see, the more and more I do this, changing the deltas, trying to get the guy on the top of the hill is just a little scary. So let's get back to our original 28. It was like 28. And we're at 20 deltas, which means there's a 44% chance the market will touch that. So, and then we were up here at 37. Or we were at 37. Yeah. And so, I'm going to put this order in. I'll say 95. Even though that 94, excuse me, we'll go 94. Oops. No, let's go 95. Even though that that's literally, 94. We're at the top where more than likely it won't get filled, but I'm going to put it in there anyways, just in case. Because remember, all I care about is we're getting $2 a day in theta. So we're going to put that one in. So we got SLV, we got that. KRE was the other one. Let's look at KRE just to see. And then we're going to look at some new trades. Remember, this is just the income stuff. I'm not going to go too much over calendars yet because that's another income strategy. I'm just going through the basic strangle strategy which consists of strangles and iron condors. The other strangle strategy, which is the other one, is going to be double diagonals and double calendars. That's the other strangle strategy. Again, we're just taking into account where the market can go, being totally neutral. Then I'm going to run you through what are called butterflies. You've got the all-put flat fly, which from Sheridan Mentoring. You've got regular butterflies. You've got the Matt Thiel trade butterflies. Those are also income trades. All it is you don't care if the market goes up, down, sideways, in and out, upside down, backward. It doesn't. All you care about is the theta that you get every day to bring money in, as long as that market doesn't move too much. And then you just keep the premium, kind of like an insurance company. So we're going to do that. And then we're going to go through KRE. I already got a trade started here. I think that was yesterday's trade, but let's double check. So we're just, this is pure just income driven strangle mentality. Oh, Delta Airlines was the other one. Yes, let's go Delta, because I've had a lot of luck doing airlines. And then we'll go back to KRE. Airlines have been treating me pretty well this year. Actually, the last 2 years, doing just regular strangles. I've had a really good time with airlines. Now, I think this already had earnings October 10th. This is our December 20th. December 20th, we have a strangle on 17 deltas. That we're down to 14 deltas, but there's no volume. So since there's no volume, there's no trade. But we'll just look at it. If it were a trade, 91% pays you $3, $3.33 a day. You get 146 out of 5. You're still not getting a third of it. Again, a lot of that is the pricing of the fact that there is no volume today on Delta where we want our strikes. There's nothing here. So that's off the table. KRE. We've got in KRE, this is the trade we had on. I always look at the trades that never got filled and see if they changed, because I was asking 119 credit, and it's still where it was at yesterday. And this is what I was looking for. So market really could pay us. It really hasn't. So anyways, again, no volume. I'm not seeing any volume on this. So, okay. KRE's off the table for now. Now let's look for some new ones. Okay, we checked inventory. Now we're going to check new trades and see if we can get it. And then what it is once I start running you through just the strangles, the strangle type of mentality, then once we start getting into again, this is just for selling premium, the selling premium strategies, strangles, iron condors, strictly just putting fences up there. Then we'll go through and do double diagonals, double calendars, the whole calendar mentality, which is, again, selling premium to bring money in. And that's for low volatility. So you have high volatility. Now you got low volatility. Then we'll go through the others, which are the butterflies. Because options are consisting of horizontal and vertical movement, or vertical pricing, excuse me. Vertical pricing is when you do your strikes in the same month. Iron condors, stuff like that. Horizontal pricing is calendars, double diagonals. Anything that's calendarized means you got 2 different dates. And so the mentality is a whole different there, because you want to buy volatility. Even though I check the selling volatility first to see what kind of premium is there, I want to buy volatility to take my trade. But that's a whole different thing, and we might touch it. Anyways, let's look at liquid ETFs first. I gotta hand it to Tasty. They just make things easier. I wish their filters were better though for your scan, but it is what it is. Emerging markets, look at that. Emerging markets has, where we at? We have 59, 20%. IV index is not as good as I want. It's been going up. I'll leave 0.4%. But let's check out emerging markets and see. In December, I like to go out to December because that gives us 59 days. Okay, let's go to the 16 deltas. I'm going to go to the whole number, which is 18 deltas, but it's 42, because if there's no volume. And it could be just the fact that market's just open and I'm not seeing it, but I'm not seeing any volume on this thing today. Although we've got a lot of volume on the stock. Maybe it's just the platform. We'll see. 15 deltas is the closest. Yeah, because that's a whole number. If we were to take this 66, oh, we're barely 10% in terms of we're barely 10%. But let's wait and see if there's anything coming. I don't see any volume on this. What's going on with this platform? We should be seeing volume on December contracts. There's nothing. Might be a platform thing. Not I shouldn't say platform. It might be my connection. Because sometimes the data won't get in, but that's weird that we're seeing nothing. Let's go to a different strike and see if we see. Let's go to the most recent strikes. See if we see anything coming in. Let's go to November. Yeah, okay, it must be my platform. Might be my connection not getting data. It should be getting data because I'm not seeing any volume coming in. And we should be seeing, especially on the November strike, we should be seeing something. And there was nothing in there. Maybe let me see. I don't have a lot of stuff open. I don't have anything open, so couldn't be data coming from anywhere else. What I'm gonna do is I'm gonna reload. Let me get out of the platform and come back in so we could get some data. Because I want to see volume. I can't do anything without volume because volume is king. 1 second. Yeah, I'm gonna reload the platform here and see if it was just the fact that seeing if it's just the fact that my connection maybe had been weird. Man, I had a great workout yesterday, man. I was going in to, while the platform loads, I was going in to just do, some weighted body weight rows and some just, again, it's for my muscle up training because I was doing muscle ups the other day and I felt kind of weak because I hadn't done it for over a week. I felt like because I was trying to get my muscle ups going, I felt like, man, I just can't do this. So I did like major training yesterday, but I also did strength training with like the 80-pound kettlebells. Man, that thing was hard to move. Oh my God. 80 pound, I could barely move 50. But what I did is I was doing squats and I said, let me do suitcase squats. And I didn't know it was because I can't see. So I didn't know it was 80 pounds. It was just a big kettlebell. And I just pulled it to my side and my entire body just leaned over like the Leaning Tower of Pisa. I said pizza of Pisa. And next thing I know, I was just like, but I did some suitcase squats doing that yesterday because I'm trying to train fight training. Okay, here we go. We got some volume in. Again, everything to me is like fight training. It's about getting ready for and strength training is part of fight training. So let's go back to we've got emerging markets. I think that's were we at Delta Airlines or emerging markets? Yeah, we were emerging markets. There's barely any volume. Okay, can't do this. And what happened? I guess Delta Airlines was the same thing. Barely any volume in Delta. Yeah. Wow. Yeah. I mean, that we should be seeing something. Let's see. Let's go to the November. See if there's anything. There's barely any volume on this. Let's go to the strikes that are out here now. So we're seeing some volume. Okay. Seeing it. Yeah, okay. This makes sense. Right here for the October 25th, but I'm not trading the next 2 days expiration. That's just throwing money down a well. Okay. So I was on high liquidity. Let's go back to that high liquidity watch list. But yeah, man, when I was doing I pull because I do calf workouts with a weight belt. And because I always use my weight belt when I work out when I'm doing and I did a bunch of dips. I increased my dips because I would do weighted dips, and I think I can do 65-pound weighted dips, and I rep those out with a 65-pound kettlebell, and that's really hard because I had shoulder injuries. In my age, when you're getting in my age, I'd say anywhere over the age of 60, in my age group, doing 60-pound kettlebells, doing dips, because your shoulders really take a hit. And I've had shoulder injuries for like the last 2 years. So I'm sitting here trying to do tricep, doing my tricep workouts, because that consists of a lot of different push-ups, pike push-ups, Russian push-ups, Mike Tyson push-ups, and then I'll do dips. And that's what I did yesterday, because I always do push-pull legs. I do full body every day. And I did these dips and I put the kettlebell on and I couldn't see it. So I figured, okay, it's probably 45 pounds. It's like putting a plate on. And it was a lot heavier than I normally. So, I didn't know it until I could, it's textile. So you could actually feel the letters. And I felt the letters and I was like, ooh, but I was able to rep it out. It was hard. I was able to rep them out. The pull-ups, was because I did pull-ups 2 days in a row. Muscle up day was 2 days ago. Yesterday was strength training, which is I do 2 plates, 2 45 plates, and I just do as many 1 rep maxes as I can. If I do 2 rep max, I'll do as many as I can until I drop. Then I go back down to a 45 and a 25, and I'll rep those out as many as I can until I drop. And then I go to 45, and that's when I change my grip, because yesterday was the changing of the grip, the front grip, which is more lat and forearm and bicep oriented. So I did that. And then I did ab work, because, Bruce Lee did the dragonfly. Why can't I do it? If Bruce Lee can do it, I can do it. So I decided I did, toes to bar. I do a lot of those, and, knee raises for side crunches, lateral knee raises. And then I'll do I was going to do deadlift yesterday, but I was just too tired, not sleeping much, because I like to do deadlifts at least once a week. Especially when you're my age, in this age group, you got to be very careful doing a lot of deadlifts, because back pain is easy for somebody my age. And when I do deadlifts, I don't just do deadlifts like, let me just do 1 plate. I start off with 2 plates. And if I could get 3 plates, because my goal is 4 plates by next year, or at least by springtime next year, I want to do 4 plates, which would be, if I did 4 plates, that would be, what is that, 180 per side? What's that, about 360? And at my age, deadlifting 360 is not recommended, but that's my goal by spring next year. But anyways, EWZ, let's take a look at that. Again, Brother Will, this is for purely fight training, because I told you I found a boxing gym, and I think they do Muay Thai as well up there. But pure fight training. Okay, 75 cents. Again, let's go to let's go to the strangle. For its standard deviation, this one is Brazil, and we're only getting 57 cents on 280. So it's not giving you the premium. Our indexes, we've got a lot of IV rank. We've got a high IV index on EWZ. Let's check the index though. IV rank. Let's check if the high index. Okay, it's been going. Let's see. No, has it been going up? Nope. IV rank is good. It's got a lot of contracts. IV index is good. Problem is that it's been going down. It went down 4%. So that, I don't like taking trades where implied volatility has gone down 4% in the last 5 days. That's throwing money down a well. I want to see it go up. I like to see. I always do implied volatility when it's, or the trend. What it is showing you the trend of implied volatility, whether it's going up or down in the last 5 days. If it hasn't been going up in the last 5 days, that's throwing money down a well. EWW, is this Mexico? I think this is Mexico. Yeah, Mexico. Let's see if there's any volume in Mexico. No, you can tell right away there's no weekly strikes. Yeah, you're going to tell there's nothing there. Basically nobody. There's something up, because I know that should have something. 2 contracts. There's nobody here. It's like going to a party and nobody's there. FXI. Now that should. Even though the volume here, you got millions of contracts, that are being traded. But when you go down to the option contracts, where are those contracts traded? What is going on? No volume. Let's see if there's volume on the you're going to see it on the 25th. You should see. Yeah, look at that. thousands of contracts, thousands of contracts. But when I go to November expiration, but I'm not going to trade this close. It's only 23 days. Barely any contracts. So, there's not a lot of party, not a lot of folks into the party in this ETF. We looked at TLT, or did we look at TLT? I think we looked at it. Let's look at it again. Look at TLT. Let's see what we got. TLT, millions of contracts there. Let's just see what's going on in December, just to see, not like I'm gonna trade it, because again, the pricing, you're not making any money. Okay, see, TLT's got contracts going into December. 19, again, looking just at the strangle, because that's about, let's see, where's the 19, where was that at? 19 deltas. No, we'll go 15 deltas, because that's at 85. I like to go to round numbers. When I say round, either multiples of 5 or 0. So it's either 85, 90, 95, 100, 105, because that's where you'll see a lot of more contracts being traded in areas like that. It's very, very, and so if our 16 deltas are closer to 85, even though it's at 86, if it's closer to 85, I'll take the 85 because of the number of contracts. Then let's go to the upside, see where our 16 deltas are. All right, 99, that means I'll take 100, which is 13 deltas. 102, yeah, that was only 10%. 10%, yeah, that was what had happened. So that just means I'd have to look at this trade differently. Instead of doing an iron condor or strangle, I would do an income trade. Possibly, let's take a look. Well, since volatility is already high and it's been going up, I would not do a buying volatility trade with this in this month. So I would look at something that I could sell volatility. I could sell volatility in that month and take advantage of the high volatility, but not using the strikes as as selling those strikes, because you're not going to make money selling those strikes. It's only 10% that you're going to be making of the buying power. Even if I went ahead and I always go to the very close condors, because if I go to very close condors, it's going to cut your buying power down. But still yet, how much am I going to be getting? You're only getting 30 cents on $1.64. So you're only getting 20% on the buying power. It's not worth it, especially with commissions and everything else. It's basically, you're in a break-even situation. But I do like the fact that it's elevated volatility. I would also look at, it's been trending down, going down, down and down and down and down. So what would I do? If I look at the strangle to see where's the risk. Is the risk to the upside or the downside? And this would possibly be more of a butterfly trade than a strangle, because I want to take advantage of selling volatility, but I want to see to what side is the volatility on, the upside or the downside. Well, clearly there's risk to the upside. You can see that just by the nature of okay, let's do that again. Look at how the distance between where that strike is and that curvy line, the mountain, which is our theoretical, means what's happening today. And then look at how close this is. So clearly there's risk to the upside. So if I did something like this, I would do a butterfly. Not to say bonds will go up, but since there's more risk to the upside, I would put a butterfly down here with no risk to the upside. So I'd put like a butterfly down at, say, around the down at the 85. And a butterfly, I was showing you just a little bit of it yesterday. Basically, you want the mountain to be down in around the 85 range. And then basically you got the high of the mountain there. It curves down and it starts to curve back up. It's like what we had in GDX. Oh yeah, let's check GDX real quick. Because I want to make sure, because that GDX, I do want to get into that. All right, I got the GDX on. That's a butterfly. We still need to get some more trades on, because I need to fill that up. I'm trying to get like 5 or 6 trades a day, hopefully. Give Tasty Trade 5 or 6 commissions, at least that a day, if I could get filled. anyways, if I put the butterfly down here, and a lot of it is pricing. So if I go down here at our short strike, you know, that's the again, we're not getting a lot of money for this. Okay. So I want to get paid for the butterfly. So I go to the expected move. They're saying this thing can move $5 between, $5 between now and December 21st. If we look at the average true range, it's saying this thing can go up or down 21. I mean, it goes up or down $2 a day. So this thing can move. So I got to take in context. Butterflies are a trade you have to hold a lot longer in order to, even though you're going to get your profit, it's not like a strangle where you could get out within a certain amount of time. In order for you to make the money in butterflies, you need to hold it a little longer to get the profit. And you'll see here when we look at theta why. Okay, so expected move, they say $5. So if I go down, it's trading at 91. We go down $5. We're looking at 96. Okay. This thing will go down $5 from where it's at. 86, excuse me. We'll go down to 86. So 86 is 19 delta. That's close to where we're at. But you know what? Since it's a butterfly, I don't mind. If I go down to the 23 delta, that means it's got a 46% chance of the market getting down there between now and expiration. Remember, it's called probability of touch. You just double your standard deviation, and that tells you the probability that it'll touch. So if you got a 16 delta, that means there's a 32% chance that market will get down there. It doesn't have to, but at least it'll get down there or up there, depending on your where your strikes are at. So if I did a butterfly, remember I talked about the security guard. Think of this right here as a lawyer. I mean, this is your defendant, and this is P. Diddy, the red line. You've got, since I want the market to go up and I want no risk to the upside, I want a lawyer that's standing closer to P. Diddy and has more interest. He's like the head lawyer. He's the one that's closest on the case. The other lawyers are like the paralegals and everybody else that are a little farther on the case. And that's how I look at a butterfly. So when we look at it on the curve, we're looking at, let's open this up a little bit. Oops. I think I did this wrong. Hold on. We got to do one strike. Keep in mind, you only get two lawyers. Okay, two lawyers. So let's go down here and take the quantity down here, and we'll go down here and take that quantity of that guy down. So we've got the defendant right here in red. There's two contracts here. One lawyer. The defendant has two contracts layered up. It just tells you how intense and much trouble he's in. And one lawyer to each side of the defendant. The closest lawyer is the one that's going to take the risk off of you. So if we look at this again, when we're looking to the upside, there is no risk. Okay, because we're getting a credit. If the market went through the roof between now, goes through the roof between now and December 21st or December 20th, we keep that $12 credit. Now, since bonds have been falling and falling and falling, right here is remember that expected move that they're saying it more than likely will touch between now and then. Even though that's the case, and I don't mind that, the thing is the key is you want the market to actually end up here. Okay, you want it to end up here on that date. The thing is, the chances of that happening, I have a better chance of getting pregnant with septuplets than this market pinning in between that triangle, because that means you'll make $111 or 111 bucks if it pins in that triangle. The chances of that getting in that triangle, I have a better chance of being, of having Tucker Carlson as my running mate as president, and we win, and Kamala Harris and Donald Trump go home, and I'll be president, and he'll be vice president. I have a better chance of that happening, of the market pinning in that particular area than that. And that's because I'm not using my Zumbi or none of my I'm just saying, just in terms of just using options. If I use my Zumbi, the thing I showed you, you best believe I could pin it. Or the aggregate, the lotto ticket trade, I could pin it. But what I'm doing is just showing you the mechanics of what this is all about. But The thing is this is your mountain. And if we do this one, we don't want him to be on the top of the mountain, because the top of the mountain's way up here. He'd have to go there. What we want is, as this thing goes each day, this mountain, this side of the mountain starts going closer and closer to this, to where this peak is, where this triangle is, and that's each day. And you know what? Let's do this. I can show you better than I can tell you. As we go to each day, and we're just going up each day, notice how this is starting to change, and the mountain is going closer toward the peak. See how the mountain got closer toward the peak of that triangle? And now this is our mountain. Our mountain is now kind of closer where we're at. That's what we want. We want this guy, this little triangle, that's the guy. We want him to be sitting right over there on top of P. Diddy, which is the red thing. And the thing is, we would get, if it got down there, we would literally be up. Just, by the market doing that, we would be up, if the market could get down there. But, this is just an income-driven trade, because there's only, in order for it to get down there, it's down at the 23 delta, which means it's a 23% chance that the market will close in that area. Now, there is a 46% chance that it'll get down there between now and December, but it's out at that expected move, kind of close to that standard deviation. So we're going to put this one on, but you know what? Instead of 12, I want the market to come up to me. If it doesn't come up, then I'll take whatever price is toward the end of the, toward the middle of the day. So I'm going to go in there and see if the market will come up. If it comes up a little bit, then I'll come down at it. Again, this is like a bid, like at an auction, and that's all it is. You have, in order for this trade to, to make you money, it's got a 95% chance that this trade is going to come out, at least 50%, which is nothing. That's $8. It's got, you get paid only 19 cents a day. Remember I told you it's different in theta? You get an 81% chance of making the $16. I don't care about that. My thing, this is more of a speculative income trade. I'm speculating that market will either stay where it is, or it'll pin at that point where we're at. Okay. Now, to defend, if this market gets past my triangle, then I have to look at it differently to defend it. I would defend this market if it got past my triangle. The first thing I would do is see how much, the half of the P. Diddy guy here, and how much this and this. Because remember, this is this is $1. So between this and the what's called a vertical spread, from 87 put and the 88 put, if I made an entire dollar on that the value of that is $1, because that's exactly, basically the cost of it. If I make that dollar, I'm gonna take that trade off, and then all I'm left with is this lawyer and the other half of the P. Diddy. Because remember, we got 2 contracts of P. Diddy on there. So that's it, the trade I would make. So you know what? We're gonna put this one on and wait and see if it gets filled. These are very, very simple, low risk, high, or low risk trades, most probable trades, but I'm giving you the idea of the concept of income, not, even though it's speculative, because you think the market will either go up or just won't go down too much. It'll either go up, stay where it is, and not go down too much, and you'll make money. The only way you make money is if it crashes and it goes down beyond the expected moves. But if the market goes up, if it stays where it is, or if it doesn't go down too far, you could take the money and run, and you won't have. But that was TLT. Let's see what else was. Oh yeah, okay. So we these are the ETFs. Okay, FXI. I was looking at China, and remember that's a geopolitical play. Remember when FXI just kept spiking after China did the stimulus? Look at what happened after Fed lowered interest rates. Markets continued. The markets went up, but interest rates continued to go up, even though they stimulated. China stimulated its economy, and it's popped up to the upside, and now it's starting to go down. I think that FXI is possibly in a place where it could range for at least the next few weeks. The only problem is look at volatility. Volatility is starting to come down. So that's kind of scary. This thing can move easily $2 in the last 21 days. It can move $2 one way or the other. even though it's only up 25 cents. So if I were to do this, let's start out with the strangle. December 20th. I want to see how much it costs. Think of the strangle that I look at. My logic is this. A strangle is like an electric fence. And you've got some of the most expensive ribeye tasting cattle in your stable. And and the cost of that fence is going to tell you, to keep your cattle safe from wolves and everything else. That means you could sell your cattle at a high price. So if you go to that fence and that fence is not, the electricity is not that good, the cost of that fence, the electricity is not that good, you're not getting a lot of premium, that affects what people think about your cattle. Because they're thinking, hey, his fence might not be able to, to save his cattle. And that's the thing I really get scared of. Hold on for 1 sec. So a strangle to me, Brother Will, is like a fence. And that fence has to protect your cattle. And the electricity in that fence tells you just how much premium you could sell your cattle for. If the fence doesn't have a lot of electricity, then clearly a lot of folks are going to look that your cattle are vulnerable, and therefore you can't sell them as high as you can. And that's how I look at it. Oops. Uh-oh. I think we were not sharing screen. Man, we might have missed a lot of good info. I hope that you were able to get that butterfly in TLT, because I really like that butterfly. But anyways, looking at the strangle for standard deviation, i.e. our fence, we'll have to go to 20 here, and then we'll go to the other delta around the 16-ish delta, our fence. That's at 38. Let's go down to the 19. There's a lot of contracts there. So we're looking at basically getting $1 out of 320. This is not bad. This is not a bad trade. I don't mind this. Okay, the buying power is 320. We're getting close to a third, not a pure third, but I'm going to see if the market could come up against me. 93% chance of making 50% of this trade. You got theta, you're getting paid $2 a day for it. Probability of profit is 67%. Keep in mind, the gamma is definitely not in our favor. What do I mean by that? The mountaintop. Even though the delta is less than 1, it's basically delta neutral. Is China looking to do something again that crazy? Chances are they are. Look at that. If this market pops to the upside and just goes ridiculously high, you'd be down $156. Remember, this thing moves $2 easily, one way or the other. If it knocks down to the other side, you'd be down about $89. This thing can easily get there. It could easily just, and let me just double check, because I had per contract IVs. So $136 as opposed to the 57. Okay, whatever. I had the contract IVs. That's the thing that I'm still kind of, it's kind of confusing on Tasty, because they're using each contract implied volatilities. So anyways, look at that mountain. It's very steep. And China could pull another, we're going to do another stimulus thing. And, because a lot of folks got torn out the frame on that because of that. So, again, this is one of those things where, I'm thinking that maybe because of elections that this thing will settle down a bit. And if Trump gets in, don't be surprised if this thing goes back down to 27. But I'm thinking that it could stay in a range at least for the next few days. And like I said, China could pull out and do what they did before. Will people buy the okie doke like they did last time? Because a lot of folks got hurt. This thing has a probability of it has the it looks like they expect it to move about $3. I'll say $4 of it. So they expect us to go anywhere from 33 to 37, where our short strike is, or 33 to 29, where our short strike is. So we're at the expected moves, where they think this market could go. We're getting about a third of our buying power for credit. We get paid $2 a day. So I don't mind this trade. But you know what? I'll mind it better if I can actually make a market come to me. And I'm going to put that trade on. Let's do some more. Now we're going to go into high option volatility. So we got some trades that are on. We're just sitting on them. And if they get filled, they get filled. That's all it is. Put the trades on, see if they get filled. Now we got earnings season, so some of these might show up in the earnings. And I'll show you some directional trades later on, like in and out spreads. Theo calls them in and out spreads. Some folks call them at the money verticals. These are just, simple if you think the market's going to go up or down, but you don't have to pay too much for it. Very simple trades. HYG. Let's see where HYG is. No. Implied, look at the IV indexes down there at the floor. High option volume. Micron, the chip maker. Does that have earnings? Let's see if Micron had earnings or if it has earnings coming up. I think it does. I think it does. Quote details. Wait, it doesn't have earnings? I thought it did. No earnings. Wow, no dividends, no earnings. Maybe it had it last week. Anyways, look at Micron. IV index is 48, 42 on the IV rank. Millions of shares. I love this trade. This stock is a cool stock. December. Let's go out there. First standard deviation. Of course, this is definitely going to be a more expensive stock. First standard deviation. Our fence. What does our fence look like? Okay. You're getting about a third. No, you're getting almost a half of your let's bring this down to 14. Say a third of your 88% chance, 88% chance that you get the 50%. You got the $10 a day, which you're getting, $10 a day of theta. Probability of profit is 73%. This is not bad. Let's see what we got in our deltas. If we move this over here, let's see where our risk is, risk analysis. And what we're going to do, let's go with our even our deltas out for risk analysis. We're at 18. Let's go 15 deltas here, 15 here, and 14 here. And let's just see. And you're getting about a third of the buying power. So this is not bad. Let's see. Look at the curve. Should have risk to the upside. Yeah, you got more risk because if it went all the way up here, you'd be down. You'd be down about $800 over on this side, and you'd only be down $300 on this side if the market went, and popped up or down. This thing has the ability to move $8 in the next 21 days. You can move $8. It says it can move $4, but again, I double it. Then Micron could easily do that. Remember, on one day here, and I think that might have been earnings, it went from 95 to 114. 5 days ago, it went from 106 to about 114, and that was $8. So this thing can move $8 like it's nothing, and I like to put that in consideration. So going back to here, of course, it's more expensive, and I don't want to put that kind of buying power out there of $1,000 in just one stock, even though everything else is looking good. So what do? We say, since it's high implied, let's look at our implied index per expiration. Look at that. So it's, it looks like it may come down, but not till next year in terms of implied. The expirations are about the same, so it'll either stay where it's at or, more than likely stay where it's at. So looking at that, what are we looking at? We're looking at how could we trade this? We could trade it like this. 87.5, 82.5. We'll do $5 strikes. 135, 140. Doing they do have contracts, not massive amounts, but they do have contracts. So we would be getting more than about a third the width of our strikes if we did this as an iron condor. We would get a third the width of our strikes. What would happen in a week if this condor moved? Let's go back. 29. Okay, we're not going to get that kind of pricing in there. So if we went to the 82 instead of the 87, we'll go 9. No, we'll go 90.85. Okay, so we get 128 of 373. So in the December, we'll go 90.85. What would happen if this thing, um, went and a week after 1 week? Damn, it's looking like we'd make damn near half our money from no, not a week, 2 weeks. In 2 weeks, we could easily make half our money. Because remember, this is the expiration now of 120, 128. And after 2 weeks, if all things being equal, this thing would go down to 62. So I like Micron. I like you, Micron. Except I'm going to make the market come to me. And then I'll play around with it. I'm going to see if the market doesn't come to me at a certain time of the day, I will take this trade at the original at 128 if they'll fill it. But I do like this. I like you, Micron. So, and let's take a look at our curve again. I mean, it checks all the boxes, so I don't care. I don't mind doing that. Yes, he's not on the mountain. We need him on the mountain. The thing about this is you got 82% chance of this trade giving you at least that $62 because we're getting a lot of credit for it. We're getting about a third. We're getting over a third the width of the strikes. We've got, I'm gonna bring this down to 130 because I like this trade. We've got, but keep in mind this thing can move, and if it moves, I have to, here's the other thing that I do when I start, because remember, I always think that when I get into a trade, I'm gonna have to adjust. So if this thing moves on us, I have to think in terms of, okay, I have to start moving these up or down to accommodate a market move, and that's adding more buying power to what I'm doing, adding more to it as this thing moves on me. If it went down to the 135, I'd have to go $5 down to the 130. It adds more buying power, and that's that's one of those things that I have to really, really be careful of, because every time I get into a trade, the first thing I know, I have to adjust it. I know the market's gonna move to where I have to adjust. It's something you can't avoid. All markets do that to you. So we're gonna make the market come up to us, even though it's going down a little bit. I want to see if Micron will go up at the end of the day. So I don't mind this trade. I like this. Let's see where we're at on IWM. Yeah, so IWM's not doing anything. We're barely moving on that. So we've got some trades. Let me see. Let's get some more on. And hopefully one of these will get filled later on. Bank of America, 37 or 32. Bank of America, 27. I think, does that have earnings? No, banking earnings were the first ones to happen, so it should not have it. Bank of America. It still has, volatility's been going up. Not like Micron, but it has been going up a little bit. So I don't mind that. XLE, I don't mind that as well. Another ETF. I do not mind Bank of America or LXC. High implied volatility rank, except these are not in the 30s. I like Bank of America better than XLE. Bank of America. Man, did we just have a tremor? I just felt something shake. Get a lot of tremors out here. Bank of America. Wait, we got dividends. I don't care. As long as it doesn't hit our short strike in dividends, that's a whole different thing. If you sell a cost spread, look at that put. That's and if that dividend's paying, if that is paying more than what you have in that cost spread, you're gonna have to get out. I mean, that's just, anytime you have either a cost spread that you're selling and there's dividends, you be very careful because you end up having to pay the dividend. But this, I'm not worried because there should be a lot of extrinsic value on this, and we'll be out of this trade before then. We're not going to stay in Bank of America to December. 88 of 510. Yeah, it's not a lot of, this, what, a little bit over, like, let's see, what would that be? 16, 17%? I don't like it. 17%. Because even if I did $3 away in terms of, okay, we just got filled in SLV. Cool. Even if I went there 60 of 240, that's only a quarter of our buying power. So good, we got SLV. Let me see where SLV is, so that way we can see where we stand. Where did that get filled? So SLV is moving around a bit, which means, let's look at our curve. Cool. So we're in. We got a position on SLV, and all we got to do is just manage. Like I said, I always get into the trades knowing I'm going to have to move this around. That's just the nature of the game. I don't mind the fact that it's kind of close to here. It's just when it goes up here, this is just what I fear, because even though you get paid more for the upside, you also have to pay more risk. As Dr. Jim says over there in Tasty Trade, you got a gimme and you got a gotcha. For each gimme is a gotcha. So you might get something that's like a gimme, but you're going to have to pay for it. Bank of America, I'll look at a different strategy on that. Let's see what we got on, XLE is the same problem. XLE, I don't think is going to give us the, let me see what kind of volume we got out there in XLE in December. Yeah, there's no volume. Well, you got a couple thousand contracts here. Nothing really major stand out on XLE. At the standard deviation, well, you do have some. At XLE, for standard deviation, you got 2,500 contracts. Standard deviation down here, though, you don't have that. So we go, what are we at? That was the 14 delta. Let's go to 14 deltas over here. So that somebody thinks that XLE is going to go to the upside. Are they predicting a war? Is that because this is energy? Maybe they're predicting that you're going to have the major war. You're only getting 1/10 of the buying power. So this is definitely not for, again, think of the two strikes, the two red lines, as a fence, an electric fence. And the more electricity you get in there, everything between that is your cattle that you're selling. You're selling all those cows in between that, in between those fences. And the thing is, the more electricity means you got good cows. So if you're only getting 10% of the buying power instead of like 30% of the buying power or 40% of the buying power, that means your cows are, they must not be very good cows. Might be scattered. Some might be eaten by wolves. Some might be already on somebody's dinner plate because they had it at an Aldi's or something and didn't sell your cattle at Ruth's Chris Steakhouse. So, so that's how I think of it, in terms of, the next trade. I want that Micron to get filled. I'm definitely looking at Micron. Hopefully that one will get filled. But anyways, this will give you some context in terms of what I'm looking at, and how I'm looking at. So the Micron trade, I'm going to keep chasing that around till that gets filled because I like that. All that premium that was in there, I want that premium. And I can manage that, even though it's going to be hard to manage because of the buying power effect. It's going to cost some money to manage that. It's not going to be cheap. Managing Micron is going to cost a few pennies, because those strikes are going to move around. And I anticipate that. Remember, that thing can move, what was it, $8? So that means I know I'm going to end up moving those strikes. That's why naked strangles and stuff are better, because you don't have that fence, that protection. You don't have PD's lawyers on each side of you, which is what the green ones are. They're like lawyers, and they're standing on each side, and you can't move the defendant, which are the red ones, around. So, if the lawyers on each side, it's good because you're protected in the courtroom of markets, but but you still have limitations. So that's just how I look at it. So anyways, we got a lot. So we got GDX, Micron, FXI, TLT, SLV. SLV got filled. So hopefully we'll get filled on TLT, FXI, Micron, GDX. And if there might be some more trades in the afternoon that I'll put on, or at least in the next, in the next hour or so, I may go through this again and see if there's anything new in terms of volatility. But what I showed you normally only takes me 15 minutes a day to do. I put them on and then I go about my day. I'm just taking this amount of time so I could show you. Anyways, y'all take care. And always good to see you, KW.